Everybody, and thank you for being here. You know what today is, don't you? Today is Back to the Future Day, right? And I was just kind of thinking about that with Back to the Future, that, you know, if you looked at that movie, it's actually Back to the Future 2, okay? With the hoverboards, well, we don't have hoverboards. With cars that fly and all that type of thing, we don't have cars that fly, and that type of thing. But when you, one of the things that kind of strikes me with this particular event is how prescient your society has been to put on this program over the years, starting 13 years ago when I got involved after that first year. And it just is really quite remarkable because that is something that is held. This program is held, unlike Back to the Future with this forecast. This particular program has held together very well, and the alternative investment space is one that is risen quite a bit in prominence over the last number of years. It is one of the things that anyone who is in the investment profession, particularly those new CFA charter holders, and congratulations to all of you, that it's a career path, it's a career opportunity also to explore. It's not simply an asset class, but it's something that has grown and evolved, and it's one that in the 13 years that you've been running this program has actually gotten stronger over time, and it's and I'm thrilled. You know, when I first did this, it was, for me, it was, what's a hedge fund? And it started out being just about hedge funds, but then we've incorporated into private equity and other aspects of alternative investments, and it's a great program. It's a great opportunity to explore this field, and that's what we're going to do tonight. One thing that you should know if you've not attended before this particular event, this is not a how-to. This is not, how do I start a hedge fund? How do I start a private equity fund? It's not that. This is really very much about the industry, what's going on, the trends, the themes that are taking place within the industry. And we have a fantastic panel that will help us understand and explore that. So I'm going to ask our panelists to introduce themselves in a moment, but first just a quick mention that the program format that we have for this evening is really pretty straightforward. I ask questions of our panelists, then you ask questions of our panelists, and then at the end they leave us with one closing comment, one thought that they would like to leave with us that maybe we've covered during the evening, we haven't covered, something that they're working on, something that is new, a last thought that they would like to give us and leave us with. And then we'll have Phil come up and close out the evening. So if you look at that format, that means that we, meaning starting with me and then you, are in complete control of this program, and they get the last little sliver at the end to have that one, you know, that control element that's there. So with that, what I'd like to do is ask our panelists in their own words to introduce themselves, their firm, what they do, their work, and then we'll engage in the discussion. And I guess the best way to do this maybe is we go outside in. So Tom, why don't you take the microphone and tell us a little bit about you, your firm, and all.
Tom Krasner, Concise Capital. We're a SEC-registered investment advisor in Miami. We specialize in a niche of the high-yield bond market, short maturity, under-followed high-yield bonds. We run a hedge fund that has about $100 million in it, a large separate account, and a long-only strategy as well. We are launching a UCITS vehicle in November with about $50 million, and I think total assets a little over 200.
Thank you, Tom. Lawrence?
Lawrence Calcano, iCapital Network. So we've created a marketplace for high net worth investors to access and invest in alternative managers. One of the things that we observed in the marketplace is that, you know, there are a lot of folks that are looking for an opportunity to invest in alternative managers. It's very difficult to get growth in the public markets today. It's very difficult to find yield in the fixed income markets. And so alternatives, I think, provide a very viable investment vehicle for a lot of high net worth investors. But historically, they haven't had access to funds. They don't even know what funds are in the market. If they find a fund, the minimums tend to be extremely high, $5, $10, $20 million. And for many folks, that creates a situation that doesn't work because you can't build a diversified portfolio with those kinds of minimums. So we've created a marketplace where on the one end, on the supply side, we've partnered with 15 of the largest placement agents that raise capital from 4 private equity firms and 4 hedge funds, so Credit Suisse, Park Hill, Monument, Eaton, et cetera, which gives us systematic access to supply. And on the supply side, we've built a network that now is in excess of $1.3 trillion of registered investment, and that's from RIAs. There's over 500 entities, RIAs, single-family office, multifamily office, individual qualified purchasers, and we connect them all with a technology-enabled network so any investor can see everything about a fund right online, and they can, if they choose to invest, they can invest directly without having to send FedEx envelopes, without having to have those FedEx envelopes get sent back incorrectly filled out. All of it happens online, electronic signature, et cetera, and then we do all the administration and create feeder vehicles for people to invest as little as $100,000, so somebody could really build a diversified portfolio in private equity or hedge.
Thank you, Lawrence. Brodi?
Hi, I'm Brodi Jackson. I am one of the founders of Caerus Ventures. We are a seed and Series A venture capital firm based in West Palm Beach, Florida. We focus on high-tech companies in the hardware and software space. We invest not only in Florida, but really across the US, Canada, and potentially Europe. We build a very concentrated portfolio, so even though we invest in early stages, we're not a micro VC that will invest in a portfolio of, say, 50 companies. We have much smaller 10 to 15 company portfolios where we are actively involved and engaged with our companies. So we are taking a very hands-on approach to management. And for us, being an alternative manager, we think it's, you've got to, if you're going to be demanding illiquidity from your investors, you have to really be able to demonstrate that you have a uniqueness to your strategy. And so that's really what we think is our edge and competitive advantage, which we think we have to deliver on to be able to be an alternative manager.
Thank you. Neil?
Neil Waldman. I run Waldman Capital Management. We are a fund of hedge funds. We focus on fundamental research-oriented long-short equity hedge fund managers. The portfolio is fairly concentrated by design. We target between 8 and 12 underlying managers. Currently, we're at 10. We try to find best-of-breed stock pickers across the country that fish in different ponds from one another. So the portfolio is diversified across some sector funds, funds that focus on different geographies, funds that focus on different market caps. And the objective is to sort of take the boom-bust cycle out of investing by finding talented managers that can go long and short and, in theory, make money in a variety of different market environments.
Thank you. And Chris?
Hi, my name is Chris Battifarano. I'm the Director of Research at GenSpring Family Offices. We are a $10 billion multifamily office headquartered in Jupiter. The firm is wholly owned by SunTrust Bank, which acquired the firm in 2001, which is coincidentally the year I joined the firm. The firm was originally established by Hap Perry and his family in 1989. My role at the firm as Director of Research is I'm responsible for all of our hedge fund manager research. I lead a team of 7 analysts. We scour the globe for hedge funds for usage by our clients. I also manage a fund of funds internally for the firm of approximately $160 million. What else can I tell you? I don't know. That's probably all you want to know.
Okay, thank you. I'd like to go to you, Brodi, and then to you, Neil. Both of you use the phrase concentrated in your description of your work. And whenever I hear concentrated, I think of more risk because it really is more concentrated rather than diverse. Starting with you, Brodi, and then you, Neil, how do you address that issue if a client has a concern that you are focusing in such a concentrated area, and particularly you, Brodi, in the venture capital field?
Sure. We think that it's important to get the portfolio to a certain size, and we think 10 is very important for that. We really can't be smaller than that. But I think the flip side of it is we have to have the time and attention for our investments, particularly because these are early stage investments, and we need to be on top of it and know what's going on at all times. And to do that, we can't be spread too thin. You can't realistically do that with a portfolio of 25 to 50 companies. So we are as involved in attending trade shows with our companies when they're running a financing process. We are, they're actively engaged in the process because we need to be able to act and be nimble and know if we want to not invest any more money because we don't like the way things are going, or if this is an opportunity for us to take advantage and double down our capital. We also don't invest all of our money day one. That's sort of a thing with startup companies because they invest over multiple rounds in time. We put in a little bit of chunks at each of those stages, and it's very important for us to be able to be engaged and really understand the business to know if we want to continue that exposure, because the idea is even though you're investing in a portfolio, if a company goes out of business, hopefully you only invested in one of the rounds. You didn't go and invest in 5 of the rounds, so that the companies that make it to the end, the ones that you have the most invested capital, are the ones that are successful.
Okay, and just stay there, if you would, Brodi, just so your concentration is in the area in terms of sector, because I think that's what you were describing earlier, technology?
In fact, actually, we're not concentrated in terms of sector. We, in fact, try to build a very diversified bets. So we don't want to have 2 sector bets that are the same. We try to make sure we have an ultracapacitor company. We have, say, a medical device and healthcare consumer fitness tech device. We have fintech. We have payments. We have a hotel SaaS platform. So our sector bets, we try to very much keep.
So the concentration is more in terms of the number of positions that are there. Yours is a little bit different, Neil, is it not, in terms of the concentration of fund to funds? And then I'd like Chris to kind of talk a little bit about that.
Sure. So when you're thinking about a hedge fund, first of all, one of the reasons I'm interested in the hedge fund space is the alignment of interest. I'm personally an investor in my fund, and I require every manager that I'm putting money with that they're personally investing, ideally with the majority of their net worth in their fund. So each underlying hedge fund that I have money with is a diversified portfolio and represents the lion's share of one individual's net worth. I turn over a lot of stones looking for a gem. I guess that's how I kind of characterize my time. And every single time I put money to work in a manager, I want that investment to move the needle. So the more underlying funds you have in your portfolio, the less impact they're going to have on my returns. On the flip side, if you have too few investments, then the returns of 1 or 2 funds will dwarf the overall returns of my fund. So I try to find the happy medium, and I believe that's 8 to 12. Just as Brodi said, one of my limited resources is my time and focus, and I do extensive upfront diligence. But more importantly, after I make the investment, I really try to stay very close to what's happening with the funds and monitor them on a continuous basis. And it gets very challenging monitoring closely a large number of funds. So I kind of feel like the 8 to 12 number is the right number. And like I mentioned before, I try to invest in managers that are fishing in different ponds from one another. So a lot of the funds that I have money with are the investable universe of a lot of the managers do not overlap with the other underlying managers.
Okay, thank you. And I'm going to assume, Chris, that 8 to 12 is not the number that you are working with, that you're working with a much larger number in terms of fund to funds, just simply because of the size and the amount of assets that you have access to.
Yeah, I mean, we have capital with a lot more funds, but we're also managing a much larger asset base than
Right.
either Brody or Neil are, with all due respect. But I think as an allocator, what you need to think about, you can't just think about the number, right? So if you think about Neil's portfolio, and Neil is probably better equipped to answer this than I am, but I'll answer it. If you think about Neil's portfolio of 8 to 12 managers, there has to conservatively be 350 to 600 individual securities in that portfolio at any time, correct? Probably somewhere around that number.
I mean, again, it varies. I guess there's probably some funds where 10 stocks represent 90% of the exposure, and there are other funds, that maybe have 70 positions.
Right. So it's not. It seems more concentrated at first blush than it actually would be. When you're talking about what Brody's doing, I mean, the idea that they're going to be concentrated in just a few positions. I mean, listen, she's running an early stage venture fund, and when they're getting involved, as she characterized, they're not putting all their capital in day one. Instead, she's in a position where she can protect her LP's position for follow-on investments that come thereafter. So that's how you have to think about this. The risk is, you don't want to. She's not Carlyle or Blackstone, right? You're hiring a firm like hers for that concentration. It's
Right.
not meant to be 100% of your portfolio. Us, on the other hand, what I'm trying to do with my team is build a platform or a tool set such that all of our individual advisors that are handling the 300 plus families that we're working with can have the requisite tools they need, both on the individual hedge fund side, fund to fund side, and 40 Act fund side, to do the job they need for the individual family, because we don't run models for families. And so each of those allocations is unique to the family and unique to that entity. And so while the average family we work with has over 35 million in investable assets, there are entities within those family units that can be quite small, whether they're trust accounts or grandchild accounts, and therefore we need to be able to have solutions that can accommodate those smaller entities inside of a family.
So the orientation is going to be based upon, it's almost like a wealth management model, in the sense that each family has their own criteria, needs, and risk parameters, et cetera, and then you're trying to match the investment opportunities that are out there to this particular family need.
Precisely, and then one of the big value adds is, of course, that each of these families, like I said, they're averaging $35 million. So say a family comes to us, let's just say it's $50 million. The scale that they have versus our scale at $10 billion, all those economies of scale are passed on to the client. So in other words, they allocate as if they were a $10 billion client, when in fact they're a $50 million client. Mm-hmm. And so the resources that we bring to bear, and the increases in liquidity and in better terms that we're able to negotiate with managers, all accrue to the benefit of those families.
Right. This is great, but the contrast in terms of the size and the organizations is absolutely they're fantastic. And once again, I'm learning something with this, which is one of the great things about doing these programs. I'd like to go to you, Tom, and bring in the fixed income story into the equation, and ask you from this particular vantage point, with zero bound interest rates. Forget about, Fed's going to raise it 0.25%, that type of thing. And you are an absolute return firm, I would assume, something along those lines.
Yes.
That how are you able to capture and manage in this environment with 2% 10-year Treasury rates, with the risk factors that are increasing in terms of high yield, where there is a bit more talk about possible defaults coming down the road, and with a lot of renewals, not so much in 2016 for both high quality and high yield, but 2017 and beyond. I saw this in Financial Times. It's like a big number over the next 3-4 years, and you're going to have to roll this stuff over. So take us into your work and navigating that to generate the kind of returns that your clients are expecting based upon the mandate that you have in your firm.
Right. I mean, the first thing I'd say is that our strategy is a single strategy. It's not a home run strategy. We're trying to get about a 7% net return long term. Second, I'd say we're very agnostic about interest rates because we specialize in short duration. So if interest rates go up, we really don't care too much. And a lot of high-yield managers won't care because the history of high-yield spreads is that they tighten when interest rates go up because the economy is expanding. Now, in this cycle, it may be different. Chris and I were at a conference yesterday where we had a high-yield manager from Schroders talking about how the next 3 to 12 months is going to be very bullish for high yield. If you read Merrill Lynch's piece, or Merrill Lynch's research in high yield, they're taking the opposite view, that they're real headwinds. I think the entire issue really comes down to your belief in how the world economy is going to perform. China, if we're headed for a recession, the history of high yield is going to be is that if you have a benign economy, slow growth, high yield will do well. And high yield generically should do well, not only our strategy. If we're headed into some kind of liquidity crisis, a large rise in defaults rather than a muted or slow rise in defaults, then high yield will suffer. And that's true of any risky asset. So if you have the pessimistic view, you shouldn't be in equities, you shouldn't be in high yield, you shouldn't be in real estate, CMBS. We know that all of these risky assets have had their run because of loose monetary policy. You should be in cash and investment grade. And that's really where you should be allocating. If, on the other hand, you believe that we're in for a more benign time, maybe modest growth, maybe just a sideways economy, then a lot of these assets, including high yield, should perform relatively well.
Now, your investments, Tom, are they focused in domestic, U.S., high quality? Do you have other areas that you look for opportunities, emerging markets, for example?
Yeah. We're not in emerging markets. We're in developed markets only. The portfolio is about 80% in U.S. We also own issues that are in Canada, Australia, Europe, depending on where we find value, because we're looking under rocks where other people don't look, because we specialize in small issues. So we're not buying Burger King. We're buying smaller $50 million issue, $100 million issue, $200 million issue. And those issues right now, they have a lot of value, especially with the correction in the market. I tell you, they have a lot of value. But if we have a large, steep rise in defaults, then the value won't matter.
Now, you're not in emerging markets out of choice, or that it's not part of your mandate?
One, it's not part of our mandate. We have a joint venture with really a seed investor, a strategic investor, who helped us grow, and they wanted us to be in developed markets. Secondly, our experience and our expertise is in developed markets, and we feel much more comfortable there. And thirdly, prior to the financial crisis, we did dabble in emerging markets. Maybe we had 10% of our portfolio there. And we realized that the corporate governance wasn't what we wanted, especially in smaller issues. And so we've decided not to go in the emerging markets, even when some of the individual issues may appear attractive.
Okay, and then last question, Tom. There are a number of economists, and including recently two Fed governors, that have been talking about negative interest rates and the need for negative interest rates because as Larry Summers calls it, like there's a certain equilibrium between demand and supply, and it's not, and actually it's below zero. In order to get the economy on a more sustainable path rather than as close to stall speed that we have going on here in the United States. How are you going to manage an environment of negative interest rates? I mean, is that part of the equation of what you're looking at, or are you going to face that day, should it come, when it comes?
Well, I would hope for all of us that we don't have negative real interest rates. Negative real interest rates lead to deflation. We don't want to have a deflationary economy because that's very painful. It's going to lead to a contraction. It's going to lead to recession. And it's going to lead, I think most importantly, to a loss of confidence in the economy. When we look at the financial crisis we had in 2008, more than anything, it was a loss of confidence. And what we have now is we have confidence partially restored. Yes, there are problems in the economy. Yes, we're not growing as robustly as we were in the 1980s or 1970s. But by and large, the economy is doing well. People feel comfortable, and that gives people confidence. From our perspective, we're lenders. That gives us the confidence and our investors the confidence to lend money to companies to grow the economy. And once that confidence disappears, it's going to lead to a severe recession.
Okay, thank you. Now, Lawrence, one of the huge advantages, it strikes me, that you have is that you can see a lot of things that are out there. You know what's in your network. You see where the interests lie, where the activity is, et cetera. Can you give us a sense, without giving away, the family jewels in regards to what's going on at iCapital Network? What are some of the issues, some of the trends, some of the themes? What's trending? Look at it that way, in iCapital Network in terms of where the activity is, where the interest is by investors. Where's the money flowing to and through? Give us some sense of that, if you would.
Sure. So there's a couple of themes, if you will, that people are quite interested in. Whether they actually fully engage and invest in the themes, we'll see. But the first theme is around unicorns. I mentioned earlier that growth is really hard to find in the public markets right now. As soon as there's a good growth story, everybody invests in it, and all of a sudden the multiples don't make sense. And so if you look out right now, there's, I think, 130 unicorns in the marketplace. These are private companies with valuations in excess of $1 billion, some of which have valuations in excess of $50 or $60 or $70 billion. And so that's something that's frankly caught a lot of people's attention. One of the things that we observe is that there's about 5,100 publicly traded companies in the marketplace right now. There's about 130,000 companies that have revenues of at least $25 million in the market. And so there's a massive opportunity in the private markets to try to find growth that just doesn't exist in the public markets, given the difference in investment, the number of investment opportunities. So that's the first theme. The second theme, which is confusing, I think a lot of people have been articles recently in the journal about this, which is energy. Is now the time to jump back into energy? And I think there have been some people who have jumped in really early, and I think they've gotten hit as a result. I think our view is that now is probably too early to put money back into that. And I think there are obviously different strategies. There are credit strategies, there are private equity strategies, et cetera. But I think a lot of people are trying to figure out how to play to the energy space. There's probably a trade there, but if you're underwriting a trade that's premised on another $80 a barrel oil price, you're probably going to be disappointed in the near future. That would be our perspective on it, but there's a lot of interest. And I guess the last theme I would mention that's getting a lot of play, and Tom alluded to, what's the economic climate, is around, distressed. We think there's a lot of distressed managers raising a lot of money right now because they're looking at what's happening in China. They're looking at things like a $350 billion CMBS wall that matures in the next 2 years. And people are thinking there's going to be very significant opportunities. If you look at what's happening in Europe, a lot of the distressed players are making big bets in Europe, while at the same time a lot of the growth players are not investing in Europe because of the concerns there around growth and slowdown. So those are probably the three biggest things that people are talking about, and there's probably some very interesting opportunities in each of them if you play them right.
Mm-hmm. And CMBS stands for collateralized mortgage-backed securities?
Commercial mortgage-backed securities.
Commercial
Yeah.
mortgage-backed. Okay, thank you. And stay with you, Lawrence. In regards to the process, one of the things that's striking about private equity is its ability to really get in there, firsthand, close up. It's not terribly different than, let's say, venture capital, that you're there and you're active and, a seat on the board and influencing the outcome, as opposed to the more traditional investments where it's in the public marketplace where you are a minority holder, unless you're a Carl Icahn type. And so, you don't really have that influencing factor. You're not there in the room, so to speak, and that strikes me as being a huge advantage. If I'm looking to invest, for this family office, one of Chris's family offices, and I want to put some money, into an alternative investment space, that looks like, private equity seems very attractive in that regard.
It is, and Brodi has mentioned the work she does and digging in, and probably, if you talk to the majority of private equity managers, they would say something like that. Mm-hmm. They don't always do it. We believe that the best managers, there are three different ways you can create value in a private equity portfolio, okay? The first is financial leverage. And when we think, by the way, about private equity, we're not defining it as just buyout. We're defining it as buyout, growth, venture, all of the different structures that are drawdown structures you see with private equity. So the first is financial leverage. To us, that's a complete commodity. Okay, and so if somebody is dependent on basically borrowing 8 times EBITDA and paying down the debt, that's not a strategy that's particularly unique or competitively differentiated. The second is fundamentally improving the value of your underlying companies. To us, that is by far and away the most compelling attribute you look for in a private equity firm. We're working with a company right now that has had 11 funds. Every one of those funds are first and second quartile. The mathematical odds of that happening are sub 1% over what's close to 50 years. And we disaggregated their returns and looked at, the returns attributable to leverage, the returns attributable to multiple expansion, which I'll touch on in a second, which is the third vehicle, and the returns attributable to underlying performance. 73% of the aggregate returns out of the portfolio came from the underlying companies generating growth in EBITDA, et cetera. That to us is really where the rubber meets the road and where private equity managers, whether they're venture managers or buyout managers, really differentiate themselves. And so that we think is the most important part of the equation. The third is multiple expansion, which, by the way, if you do a really good job on the second, you're probably going to get multiple expansion. And so that's very helpful. And multiple expansion also can be a sign that the firm itself is a smart buyer and they're getting in at good value and they're able to actually translate a higher multiple against higher earnings, which obviously produces a significant return.
Thank you. Let's stay with the process theme for a moment. And Brodi, in regards to the process with venture capital, take us into it. You identify an investment opportunity, you put some money into it. You're there for how many years? What's the activity on an ongoing basis? What is the exit strategy? Help us understand that a little bit more.
Sure. So we actually start the review process pretty early on. We, I guess from a sourcing point of view, we're using our kind of network to identify companies very early on in their process, and we like to watch them for 6 to 9 months. We want to hear the presentation, then we want to see them go out and sort of achieve what they said they were going to achieve in that initial presentation. We want to see them demonstrating some of those results. To give you an idea of the size and stage company we invest in, we're investing in companies that are less than $10 million when we initially enter. So these are very small early stage companies. They do typically have revenue or some sort of traction. So it's not a concept or a business plan. They are sort of past sort of angel, friends and family. They may have done 1 or 2 seed rounds at the point that we enter. The investment due diligence process is going to take, anywhere from 1 to 3 months for us to sort of go through that process. And, that's going to entail everything from, understanding the business today. We interview customers, suppliers, strategic relationships that exist with the company currently. And then we look at our network because our biggest thing is value add. We don't want to invest in a company if we don't think our knowledge base and network can bring value to the company. So step 2 for us is really going out there and tapping into our network, making sure they're looking at this company. Are you interested in it? How would it fit in with your business? And really getting that feedback to sort of further validate the business from just what they have currently and then where we think we can take the business. And then the third part is management, because we think that that's the most important thing in early stage investing. A lot of people have the same idea. We see the exact same idea, 100 times within a month. And so no one idea is unique. And so it's the ability to have a great management team that's going to execute it, making sure they have a good board and good advisory board, that they're getting good feedback and resources. And then, we typically are talking with our management teams anywhere from once a week, every other week. It really depends on where they are in their cycle and how we can be involved with them. Anytime they're raising a follow-on round, we're going to be sort of intensely involved in that process. And we will probably deploy our capital over a course of probably 2 years with a company. And the hold period is, on average, going to be around 5 years.
Excellent, thank you. And Chris, just a last item in this process-related area. You early on stated that you are Director of Research for GenSpring, and that, take us into that, that type of work as opposed to what I think many people think of in a traditional Director of Research for a sell-side firm. How is your work as Director of Research in your organization the same as or different than a Director of Research for, let's say, a Merrill Lynch or a Morgan Stanley or somebody like that?
Yeah, it's a good question, Vinny, and I think I can answer that adequately because I started my career as a sell-side analyst. So I'd say the biggest differentiator between the research we do and the research that I did when I was an analyst working under a Director of Research was that our research is for our purposes. Their research was meant for sale. So when we research something, there are a lot of things that we focus on and touch on and we write about and talk about inside of our walls that we wouldn't want seen by others. It would be potentially highly damaging. What I mean by that is a lot of when you buy a hedge fund, you're not buying a mine, right? You're not buying like assets in the ground. You're buying people that come in and out of a building every day. And to the extent that those people don't return after they leave for the evening, you've got a major problem if they're key contributors to the process, number one. Number two, the principals of that firm need to behave and operate in a manner that is for the benefit of LPs, number one, but also in a manner such that the process, the integrity of that process can be maintained. And so one of the things that we will often see is that strategies that start off doing very, very well become jaundiced over time, largely as a result of folks sort of, and I don't think we've coined this term, but sort of shifting from the sort of asset management view to the asset gathering view. And so when the hurdle, the carry becomes less of the incentive and the management fee becomes more of the incentive, and the idea of taking this firm to the next generation, right? Potentially selling this to the public. Therefore, you want to build something that has more of an institutional flair, as opposed to what they usually originally did was sort of built something that appealed to not only themselves but to high net worth LPs. And so these behavior patterns, whether it's collecting artwork or cars or wives or whatever they're into collecting, these the things that we're very keen on observing, and it's why we go and physically meet with managers not only before we allocate capital but thereafter, because people change over time, and to the extent that they change in ways that aren't conducive to the ongoing management of the fund in the way that it was originally managed, and to the extent that that decouples from what the logical capacity constraints of that strategy are, it's a problem for us. Mm-hmm. But we don't necessarily want that information disseminated out there. So I'd say that's the major difference.
Okay, collecting mines versus mines. Would that be a good way to put it? MINDS, right?
That's an idea, Vinny. I hadn't thought of it that way, but
Okay,
yes.
Okay,
Vinny?
And as far as collecting wives, I mean, I don't know, is a Saudi royal family we're talking about? Okay.
Hey,
Anyway,
Vinny, can I just add
Yes, yeah,
one
please
thing
do,
to that? I
Brian.
completely agree with what Chris just said. I will also say, though, that part of that is completely enabled by the investment population. It's a little like why, everybody bought IBM 15 years ago, because it was IBM and nobody ever gets fired for buying IBM. And so with some of these major hedge funds that are now, 10, $20 billion, it's the safe thing for an allocator to buy. And so it's the bad side of the momentum that happens when brands become big and so forth. And I think to his point, you lose some of what half the panel is trying to do, which is there's a lot of rock hunting going on here. That kind of disappears, but the investors are partly to blame for that as well.
Excellent. My time is just about up. I have one more question I want to direct toward Neil, and then please think of your questions that you want to ask of our panel. I covered only a certain amount of the territory. It's just there's way too much that's out there that you can explore. One of the things, Neil, started off with this evening with the whole Back to the Future thing. There was another movie called Enemy of the State. I don't know if you saw that with Gene Hackman and Will Smith. And in that, Gene Hackman describes that when they're big, they're slow. When you're small, you're nimble. And relative to a lot of other entities, what you're doing is on that smaller scale, but it seems like a good argument that it gives you that flexibility because you are small, because you can be in and out of, a number of positions. Take us into your process of that from a fund to funds perspective. How do you do it? How do you fire those managers that aren't quite exactly working out? How quick are you on the trigger to being out of one manager to another? And is there a risk of going into the latest hot? How do you avoid that? How do you avoid last year's winner that becomes next year's loser? Let us understand that.
Right. So I think that the sweet spot to invest in hedge funds is when so my criteria is I like to invest in funds just as they generate enough management fee to cover a strong infrastructure. And at that point, they're not getting rich off the management fee. Typically, a manager at this point in their life cycle is still young and hungry, and they're still very nimble. And so that's probably the best spot where the interests are aligned between an investor and a hedge fund manager. The problem is, in this business, is that if you're successful over long periods of time, assets come and funds grow. And then you get to a point where you're collecting things that Chris had named. I mean, I'll give you an example. There's a fund that I invested with. They're running about $200 million. And he was fantastic at finding small cap and mid cap companies. He was really finding hidden gems that weren't owned by other hedge fund managers. And he developed a very long, successful track record. And he scaled within 3 or 4 years from $200 million to $1.5 billion. And when I first met him, he said that he wanted to get to, $600 million, maybe $800 million. And at that point, he would stop raising assets. It's a very tough thing. And people always say that, but you have to watch what they do when they get there. Because it's very hard to turn down an investor that wants to give you $100 million. And at that point, this particular manager, who is now running $1.5 billion, was flat last year. But if you do the math on 1.5 and 20, he still made, north of $20 million personally last year, and his investors lost a little bit of money. So clearly the incentives are no longer aligned like they once were. So you have to evaluate that. There's not a hard rule that you can say when a fund does this and you need to pull or you need to add. Some funds have much lower capacity than others. I have a manager in Texas who I invested with when he just crossed $100 million. He stopped taking money from outside capital when he crossed $250 million. He's at $450 now. If he gets above $500, he'll probably return capital. The reason that he does that is he does small cap stocks. And he can't be $1 billion fund. Otherwise, things change. So you just have to really kind of understand the incentives, what's driving the manager. And there are people, I mean, I have an investor in my fund that's a well-known hedge fund manager, and this guy's 72 years old and worth multiple billions of dollars, and he's just as young and hungry and engaged today as he was when he started his career. I mean, he's an anomaly. I mean, most people that become billionaires, they look at buying baseball teams or buying multiple houses. So the answer is it just depends on the person and what's driving that person. And I think you have to act accordingly. You know, the hedge fund industry has grown dramatically over the years because it's become institutionalized. Pension funds, endowments, and these are the types of firms that write $100 million tickets. And they've changed the dynamic. I tend to want to invest in managers who focus on performance, and you can do that much easier when you're smaller. So, you know, once you become a brand name fund and you start getting pension funds and endowments investing in that vehicle, you know, oftentimes, you know, the performance is no longer the same as it once was. And the other piece you mentioned about size, you know, I'm obviously smaller than Chris, but I you know, Warren Buffett has said that, you know, think about investing with a 20-hole punch card. Even if I was $1 billion fund, I don't think I would diversify my portfolio much beyond where it is. I mean, the difference between what Chris does and I do is I only focus on long-short equity. Chris focuses on other strategies outside. So it makes sense to have more managers than maybe 8 to 12. But I think 8 to 12 is kind of the right number if you're just focusing on, you know, like long-short stock picking. Again, if you're running, I don't know if I could do what I do running $1 billion, because if you break down the math and you say you want to invest in 10 managers running $1 billion, you're making $100 million investments, and a lot of the best funds don't have the capacity to take on $100 million investments for many people.
Mm-hmm. But Neil, 1.5 and 20 on $1 billion. I mean, that's not a bad. That's not a bad pay.
You know, it's interesting. I mean, that only lasts. But if people do that and take off more than they can chew, you're only going to get 1 or 2 years off of it,
right? And
you're going to kill your business. You know, there's a guy that I grew up with, and he runs a hedge fund in San Francisco, and I have a lot of respect for how he's built his business. He's running $300 million right now. He hasn't taken new investors since 2008, and he's returned over $300 million over the last 5 years. So every single time he grows due to performance, he gives it back to his investors. His performance has been stellar because he stayed at a kind of $300, $400 million level so that he can continue to do the types of things that has generated good returns. Most people in his shoes would say, keep it coming, and I'll run $1 billion, and I'd like to make, $15 million on 1.5, and if I have 1 or 2 good years, I can maybe make $100 million and I'll retire. Right. And so you have to kind of read people and what's motivating them, what they want to accomplish, and where they want to be, and then decide if it's worth staying with them or not.
Yeah, I have a feeling that in some of those cases, it's not really all about the money. Just about what they do. There's a lot of territory to cover here. We've touched on some of it. Please raise your hand. We do have cameras on the side. We're filming this. It's going to be on YouTube. It'll be on CFA South Florida Tube. It'll be on a lot of program networks coming up soon. So please do. And speak up. Questions? Any? There we go. Tony in the back.
This is for Chris. I mean, typically in these high net worth or ultra high net worth markets, how many or what's the percentage of funds allocated to alternative investments in a typical client?
It's it varies on the size and how thorough the T&E attorneys have been with them before we get to them. What I mean by that is they can create a lot of entities. They're quite good at that. And so the more entities there are, the more difficult it is for us to build. Our strong desire when building a hedge fund portfolio is to do it with individual managers. And when you're doing it with individual managers, as Neil's alluded to here, you really don't need more than 8 to 12 managers. I would agree with that assessment wholeheartedly. However, it depends on how many entities we're working with. So if you're talking about a small number of quite large entities, the number is probably 8 to 12. If it's fewer, then we may have to get into the fund-to-fund territory, or fewer managers, suffer some lack of diversification just to build the allocation. But ideally, that is quite a good sweet spot. Oh, total allocation to alternatives? Sorry, I misunderstood your question. Yeah, so in terms of total allocation to hedge funds, again, each one, there's no models, but I would say it varies anywhere from 20 to 30% generally. On average, it's about 25% firm-wide.
Okay, there was another question somewhere, right over here. Yes, sir.
Yes, hi. Could you talk about the impact of the increase in liquid alternatives and your space? And I think that can actually go to even the private equity guys, and maybe also if you could talk about if you use liquid alternatives for the family offices.
Okay, that really can open up to anyone, whoever
I can talk to
chooses.
that one if you want.
Go ahead.
So I think that one of the reasons, or the main reason that I'm investing in the hedge fund space is because that's where the talent is, right? So I think it's very difficult to generate consistent outperformance relative to the market after fees. And but I think it's possible to do, and I think there are people that can do it, just not that many of them. The people that have the characteristics that will likely outperform the market over time will choose to work in an industry that charges some derivation of 1.5 and 20 rather than less than 1% fixed. So now there's 10,000 hedge funds out there, and I would say 90% of them I wouldn't invest with if they did it for free. So you have to kind of just disregard and focus on really the true talent. Of the true talent, most of them are able to build a business on their own terms and raise enough capital and actually stop and not want to and turn away capital at one point. So most people have the mentality you can have any color you want as long as it's black. And so the question is, if you're going to build a liquid alternative product, I believe that there is massive negative selection bias. I think you're going to have a very hard time convincing one of the few talented people to run money under that construct of offering daily liquidity for much lower fees. There's one person that I got to know through as a reference he was invested in a fund that I invested with. Smart guy, been in the industry for a while, and he made a big pivot a couple of years ago to get into the liquid alt space. And this was a couple of years ago. And actually, I was just curious. I went on to his website, and he basically said there's no reason that hedge funds should charge us this money and have lockups and all this kind of stuff. And so he went out and got backed by a big family office and launched this. And looking at his long-short equity hedge fund, or fund of funds, he only had 4 managers that he was able to convince to run money under his platform. And all of them I would pass on for my fund. And if you look at the funds that I am attracted to that I would invest with, exactly 0 of them are interested in running money in the liquid space. So yes, you don't get K1s and you get 1099s, and yes, you have daily liquidity, and yes, you pay lower fees. But to some extent, you get what you pay for. And if your desire is to invest alongside the most talented investors that have the ability to make money in different market environments, I just that's not a package that I would want to put money with. Interestingly, the people that are running 40 Act product, a lot of them are the multi-billion-dollar funds that are carving out a small sleeve that is different from their main funds that are in the 40 Act space. A lot of these 40 Act funds like that because they can use big names. They can say we're running, some of our money is being run by name your multi-billion-dollar fund. Mm-hmm. I think interestingly that the manager probably doesn't have his own money in that 40 Act product. He probably has his money in the other product that's charging 1.5 and 20 and has lockups.
Okay, Tom? Yes.
We sub-advise a small liquid alt, and I'd also point to one of the reasons for liquid alts is when you're any kind of fund company, you're looking for distribution. And liquid alts give you retail distribution, as opposed to having a hedge fund, which you have to be accredited investors. But one of the difficulties, as well as the negative selection bias, is just the regulatory regime. There are things we can do in our hedge fund that we can't do in a liquid alt because it's a mutual fund. For example, we have a shorting part to our strategy where we short the IWM and we sell options. Instead of shorting the IWM, we have to buy a short ETF in place of it. It's less efficient. And so we don't feel the hedging strategy is as robust in the liquid alt as it is in our hedge fund. I mentioned we're going to be launching a UCITS vehicle. You have the same kind of regulatory issues there, which I think is going to make the UCITS vehicle, which is basically a European mutual fund, less compelling in the sense that there are restrictions on buying 144A and Reg S securities. Sometimes in the liquid alt, we have to deal with the pricing committee at the mutual fund distributor. These are people who have the IBM problem. You know, they want to play it safe. They don't want to be criticized. And so if you have a pricing issue, there have been some occasions where we sold a bond to avoid the pricing issue, where the investment decision was to hold the bond. So you have inbuilt inefficiencies because of the search for liquidity, because of the search for commonness that add to the negative selection bias that you have.
Okay. Lawrence?
One comment on the private equity version of this, opposed to the hedge fund version with these 40 Act funds. There are some very big problems with 40 Act funds. If you actually, the reason for these 40 Act funds, one of the reasons is to get at, accredited investors and mass affluent investors. But the other problem is the other objective is to try to take private equity and make it liquid, right? And a chicken is a chicken. You can't turn it into a shark, all right? And the problem with these vehicles is that they're taking an asset that has a place in your portfolio. Maybe it's not 30% of your portfolio unless you're David Swenson, but it's got a place in your portfolio for that portion that needs to be served by longer term growth, right? But if you take that product and you try to create something that it is not, you end up completely destroying the returns. Because what do you have to do to create the liquidity inherent in those 40 Act? First of all, you have to underinvest the money you get. Right? Private equity doesn't call all your money day one. It calls it over time when investments are being made. 40 Act products call all your money at once, but they can't invest it all at once. And given the interest rate environment we're in and so forth, you end up with a holdback to fund that potential liquidity. And by the way, that liquidity, you got to read the fine print. You're massively overpaying for that liquidity because the liquidity is limited to 5%. There's all kinds of other hurdles to getting at it. So you're overpaying for liquidity. You're not getting the returns you really want to try to get with private equity. And so I think there has to be a better way to create a product for accredited investors than some of these 40 Act funds.
Excellent. And just for those of you that are not as familiar with what Lawrence is describing, think of it from a corporation's point of view, where a corporation is designed to generate rates of return in their core business, but they have a lot of cash on the books, and the cash on the books then depresses the return on equity. Well, this is, in a matter of speaking, cash on the books to meet liquidity needs that then depress, but you're paying fees for that. So if I'm understanding it, it kind of flows in that direction. Please, anyone else? Anyone? Yes.
A question for Lawrence. Who's the private equity fund that you alluded to that's consistent outperformance?
She's asking me a question that would risk their private placement exemption. So in this context, I'm uncomfortable sharing that with you. I apologize. They're in market right now.
Well, there is wine and there's a bar afterwards. So it's been a little time, who knows? Okay.
If you become a registered member of iCapital Network, I'll be happy to show you who it is.
I remember an analyst, talk about Chris with sell-side analysts. I remember a sell-side analyst telling me the best source of his information was to take the chief marketing officer out for a drink. Try to get the guy drunk so that this way he can find out what was really going on with the company. Well, just,
I
yes,
never
sir.
did that when I was an analyst.
Oh, yes, sir.
So question for Chris and the other fund of fund folks. What do you use, Chris, what do you generally use to monitor managers, either on a monthly basis or outside of the newsletters, to more quantify if there's any style drift, if they're sticking to their mandate?
Yeah, we use a couple of systems. We have one qualitative system that we've built in-house. We use Hedgehog and we use PerTrack. So I don't know if that means anything to you, but that's what we use.
Okay, Neil, do you have any to add on that? Or?
So I invest exclusively in fundamental stock pickers whose portfolios are made up of level 1 liquid securities. So it's much easier to monitor those types of hedge fund managers and things that are more esoteric and harder to price. So I have some managers that send me their portfolios, both longs and shorts, on a monthly basis. I have some funds that don't want to do that but are large enough and file 13Fs. I have a lot of proprietary systems in place where I take 13F filings and then stack them on top of each other and can see very clearly things like sizing, how big positions are, understand concentration levels. I'm monitoring, one-pagers that funds give me in terms of exposures. So basically, I'm underwriting an investment. I want to make sure they're continuing to run the fund under the contracts that I initially underwrote. The three things you really have to watch out for is liquidity of the portfolio, is concentration levels, and is leverage. And so if you focus on those three things, those are the three things that really can cause funds to get into trouble. And I use things that the fund supplies, and I also use things like 13F filings. I also set up a few things where I take the 13F filings, and that helps me run liquidity analysis to understand that as a fund goes from 200 million to $1 billion, what the liquidity of the portfolio does in single stock basis, to see if there are any single stocks that they can't get out of in a week, a month, 45 days within their notice period. So those are the types of things that I track pretty closely. And I'll take the entire portfolio, and then it prices on a day or monthly basis just to understand the drivers of returns. So I can see in their portfolio, is there anything that's up a lot? Is there anything that's down a lot? And I want to make sure by looking at that it makes sense when I get the numbers reported to me. And a lot of times I get numbers reported to me on a weekly basis, some on a mid-month basis, and then a couple that only like to provide numbers on a monthly basis.
Very good. Questions? Yes, sir.
To the extent that you can, I know you want to hedge the answer because everything's relative. How are you all doing individually year to date?
Good question. Okay, why don't we go out to win, and yours is a little bit different, Tom and Lawrence. You really don't do that, but Tom, go ahead.
Okay, through September, I think we were up about 1.5%. The high yield, we compare ourselves to the HYS, which I believe was minus 2.44, and Barclays was minus 2.6. October, I expect to be flat, while these other indices are going to be up about close to 2%. So we'll still be outperforming year to date, but what you have in high yield is you have money, really waterfall effect, where large issues sell off first and they recover first. And since we're in small issues, they don't fall as sharply and they don't recover as quickly.
Thank you. Lawrence, anything?
What I'd say is there are 5 active funds on the platform right now, one of which is actually an aggregation of the 4 others, so we create an effective fund of funds. And the vehicles, the net IRR, so net of management fees and net of carry of the 4 individual sleeves we have from the last fund, because they're raising a new fund, are 22%, 20%, 24%, 14% are the returns net of fees and carry of their prior fund. That in several of the cases it's 2012, and one it's 2011.
Would you say you're at the top of your category then?
So remember, we're not these are funds that are being managed by private equity funds that we are raising sleeves of in the high net worth community. And so the answer is yes. If you look at those managers, one's a venture fund that's got an unbelievable track record going back 25 years. It's clearly top quartile. The real estate fund, which is 14%, that net of fees, that's top quartile, and that fund in 2 years has distributed back 51% of the capital already. And then the others are first quartile by any one of the metrics, whether it's MOIC, multiple of invested capital, or net IRR.
And Brody, I would imagine it's difficult for the next three to kind of exactly, because you have different, components of them, but to whatever extent you can share.
Sure. We basically mark our companies really based on the last financing round they did versus trying to peg an interim valuation. And, our portfolio right now is marked at, and we kind of look at it on a multiple basis, which we think in the venture space is really what's meaningful. And our portfolio is marked at 1.3 at this point, probably but the idea is probably half of that capital went into earlier rounds that are going to be marked higher and that's averaging with capital that just went out the door that's marked at 1. And so we're sort of blending to 1.3, and our fund has been around for a little over a year.
Okay, and Neil?
Yeah.
So I would imagine the same
I-
thing.
No, I actually have hard marks every single month. My investors get a statement that shows exactly what it's worth, and those statements are predicated on stock prices, which are fairly accurate numbers. So I have to live and die by a performance report every single month. This has been a pretty tricky year for hedge funds in aggregate. Through September, the S&P is down between 5 and 6%. The long-short equity hedge fund index that I track says the hedge funds are up between 1 and 2%. In my kind of proprietary trackings, I think the average hedge fund, the long-short equity hedge fund, is slightly down now on the year through September.
Down 222. I pulled up the numbers while we were waiting.
Oh, down 222. Yeah, it actually, given the recent downside volatility, I get about 180 funds that report to me, and I just went through the exercise for the last couple of months of putting them into a spreadsheet, and it's basically down 180 funds that I follow are on average down 0.5% through September. We're up just over 3%, so we're actually doing much better than most through September this year. We have a couple funds out of our 10 that are up double digits, and our worst performing fund is down just over 2%. So all 10 of our managers are beating the S&P this year, and a couple of them are having nice. But listen, this is a marathon, not a sprint, and every fund that I follow, and myself included, goes through periods of good performance and bad performance. What you really have to kind of focus on is how they swing the bat.
Okay, and Chris, I would imagine it's rather difficult, but to whatever extent.
No, it's actually rather easy.
Oh.
The fact that I got to go last made it really easy because I got to pull up our current numbers.
Oh, okay.
So to give you exact numbers, the diversified index is down about 79 bips year to date. Our fund that we manage in-house is up about 3. Neil talked about the hedge fund to fund side. The equity hedge is down 222 year to date. We're up about 3-ish, our average manager. And on the CTA side, the B Top 50 index is down, call it 50 bips. Our manager's down slightly less than that, so average about 45. Call it in line with the index on the CTA side. So that's where we're at.
And so we brought you guys some pretty good performers here today. All right, sounds good. Yes, sir.
You all have some great experience. You've seen a lot of different products, a lot of different managers. If you had to pick one product, company, or management manager for the next 10 years, who would it be?
One fund?
One fund or manager or company or, yeah.
Okay, any thoughts on that? I mean, that's next 10 years.
Longest best bet.
Right, yeah. Back to the Future, Part 4.
Wait,
Anyone?
I was told that I was too concentrated at 10 funds, so now you're asking me to pick one. I would never do that. Having followed 10 managers, give or take, I've been doing this for over 8 years. It's very surprising to see who your good and bad performers are in any given year. I mean, I'll give you an example. I mean, 2014, the S&P was up, 13.5%, and my two best performing managers had the lowest net exposure, and my manager with the highest net exposure underperformed. I would have never guessed that, right? I mean, I can give you numerous examples. If I knew what the market did, I still would have been wrong on who performed well. And so I think there's a lot of value in having a diversified portfolio that are behaving at different levels over different periods of time to kind of develop better risk-adjusted returns. If you just pick one fund, you're going to have some, like, take Bill Ackman as an example. I mean, he's a great investor, right? He was up 40% last year. He's probably down 20% this year. After today.
Well, we'll keep that question for the forecast event in
right. I mean,
in
so
January,
I mean, it's
right.
you know, is that the kind of stomach you want? I don't know. I mean, he may be a great. Maybe something will change. Maybe he's no longer good. But like he's generated great returns. But if you just have one horse you're betting on, you're going to develop way more volatility than I probably have the stomach for.
Okay. I think we have time. One more question. Yes, sir, in the back.
So you guys have pretty good track records, at least year to date. And I was just kind of curious for everybody on the panel, when CalPERS decided to reduce their allocation, at least to hedge funds and maybe alternatives, and I think Louisiana, Texas, I think even some of the sovereign wealth funds are considering doing the same. Is it because they didn't manage the expectations for absolute and relative returns, or is there just too much capacity in general in the alternative space? Or is it because they're so large, they're just stuck with sort of the big monolithic platforms like Bridgewater and KKR? They can't go smaller.
I discussed this in one of my quarterly letters. So I write quarterly letters since I've started, and that was a big headline news, right? One of the quote unquote most sophisticated leaders in the alternative space decided to pull out entirely. So that created a lot of headlines, and the takeaway was that hedge, if CalPERS, one of the most sophisticated institutions, can't find value in hedge funds, they must not be a good investment. So it gets back to, first of all, I think they made the right decision for them. And if I was running, I mean, what are they running? $200 billion, whatever it was. I think they had like $4 billion in hedge funds, and that represented like 1% of their overall portfolio. So even if that piece doubled, which is, let's say that piece was up 20% for the year, they make 20 basis points on their head. And it takes a lot of time and effort. And if you're putting $4 billion to work, you have to write $100, $200 million checks. And so you're limiting yourself to bigger funds, right? CalPERS can't invest in most of the funds on my radar because they would eat up the entire capacity of a lot of these funds. So for CalPERS to make hedge funds meaningful to them, they would have had to take $4 billion and take it up to $15 billion just for it to move the needle. And investing $15 billion in hedge funds is tough.
We have time for one. Anyone else want to add to that? Just one other person, or we can. All right. Go ahead.
Yeah, I would just say that I think Neil touched on this earlier as well, which is you look at Stanford, or look at Yale. They have the aggregate size of Yale's endowment is not the size of CalPERS, but they probably have the same amount. They 35% private equity allocation, which is $4-5 billion, right? Larger. And so I think part of it has to do with, frankly, just like Neil talked about the depth and the quality of the managers at his underlying managers that he invests in, it's the team. I mean, in addition to the article about CalPERS reducing their exposure, there was also an article about people at CalPERS that invested in private equity funds where they didn't understand the fees, right? So if you're a citizen of the state of California, how are you feeling about that? Okay, the largest, perhaps most sophisticated private equity or alternative investor in the world investing in products that they don't understand the fee structure. Now, were some of the big funds doing things like charging performance fees or monitoring fees and things like that? Absolutely they were. But isn't a firm like CalPERS large enough to actually lead the discipline of that? And shouldn't they, at a minimum, understand what those fees look like? And so, I don't want to come down too hard. I was not in the middle of that or whatever, but I think that it's probably a good thing that they're getting out of some of those assets, unless and until that we don't have stories about not understanding structures that they're investing in.
Okay, terrific. And with that, okay, one more question, of course, because it's Phil.
Yeah, I wanted to raise a couple of issues as I interviewed all of the panelists before selecting them. And some things came up that haven't come up tonight. And I believe a couple of you, and Neil in particular, surprisingly, invest globally, both Europe and Asia. You didn't say China necessarily, so I'd be interested in your perspective there.
Just to be clear, so I'm investing in managers that are physically located in the United States of America, just out of utilizing my limited resources. I'm not flying around the world looking for managers. And plus, it's much easier to conduct diligence on someone that's not born and raised in the other end of the world. With that said, I'm investing in funds located in the U.S. that have expertise and sometimes offices on the ground overseas. I would say I'm investing predominantly in value-oriented stock pickers, and for whatever reason, over the last year, a couple of my value-oriented stock pickers have found more value in Western Europe, as an example, than they do in the U.S. So the percentage of exposure that I've had from some of my managers in Western Europe has gone up over the last 12 to 18 months. I have a couple funds with expertise in Edge in China. Two of my funds actually have people that live in China on the ground full-time. And so I get exposure to some opportunities over there as well through funds that are physically located in the U.S.
Thank you. That's exactly the perspective I was looking for. And Lawrence may have something to say in that regard. I'd also like to get the perspective on the biggest macro risk and the biggest macro opportunity. What keeps you awake at night? I noticed Tom is emailing me at 4 a.m. in the morning, but he explained that he's training for the Senior Olympics and
From our perspective, the biggest macro risk is the risk of a global economic recession. We don't see it on the horizon, but if you believe that default rates are going to rise, that's really the risk here. That comes down, we talked briefly on the commodity sectors, whether it's a good time to invest in oil or we're early, the other metal sectors, minings. All of those sector exposures and risks really come down to China, whether China's headed into recession, and whether it's going to, and whether, if it does, will that drag the U.S. into recession. Absent that, I think we're floating along. I had lunch with another hedge fund manager in Miami who actually is very active in Latin American private equity. He was telling me that he wouldn't invest in any of the Latin American countries, and he feels the commodity cycles there are going to be very deep and very detrimental to those economies. But that's a judgment. I think Howard Marks came out a few days ago and said the one certainty about oil is it's a fool's game to try to predict the price a year from now or say where oil's going. I think that's true of almost all of the commodities out there. So there's a great deal of uncertainty, but those are the kinds of things that really keep me awake at night. Absent that, if there's liquidity out there, if the economy continues to go along, then other things will take care of themselves.
I'm a little less I'm a little less worried about cycles, because to some extent, absent what happened in 2008, we know how to live in cycles. We've all lived through really good times and really tough times. I'm more worried about the stuff that we don't understand. The Talib, the long tail events, and you've got a lot of really odd things going on in the world. You have Russia shooting in countries where U.S. troops are, where other European nations have troops. one could argue indiscriminately for a very specific agenda that is against what the majority of the world wants, but yet Russia has a seat at the table with everyone else. And so I worry about stuff like that where you don't know what's going to happen. You've got some very odd dynamics going on. Obviously, there's still the whole sort of terrorist activity that continues to, it seems like we've probably all gotten a little numb to it, in a sense that, on a regular basis there are events that are happening, and without getting into even the domestic terrorism, the very sad things that have happened in this country around schools. And so that's the stuff that I'm more worried about, because we can all deal with economic cycles. It's the stuff that we can't predict that's, potentially, it's horrible on a narrow level with the people involved, and it's potentially something that could be one of these situations could mushroom into something much larger. That's probably the stuff that I'm most concerned about.
Okay, good.
Yeah, and I think to echo that just a little bit, that I think we realized in the last crisis, and it just continues to be more and more so, just the correlation in the market, and nothing is isolated. And so events that are happening very far away from here can have a huge impact on our economy, and to some extent, may have a larger impact because they're having much more drastic swings that can have a big impact here at home. A little more micro into my world, I think the idea of unicorns and the fact that they become a theme that people are interested in is, in my world, sort of scary, because as you start seeing the masses flocking to an idea, we have a concern. And I'm sure people hear about all of the time, and it's interesting because there's been a revolutionary shift where it took AOL 5 years to get to 1 million users, it took eBay 1 year, and now a company can get there in 5 days. And so the world is a very different place, and so there's some reason for the value that's been created, but ultimately those companies have to figure out how to make money, and not all of them will. And so that's going to cause a bit of a shake up and trickle down effect, though we think there's still a lot of opportunities, actually more on the the enterprise side of that. It's the businesses figuring out how to take an opportunity of these mobile technologies.
So the question is, when I'm
What keeps you up at night?
Well, so
Macro
I take a step back and I look at the market. First of all, it's very tough to predict what's going to happen in the stock market. But if I take a step back and think about what has transpired and what the current environment looks like, over the last 6 years, the stock market has essentially tripled. Up until August, there hasn't been a 10% correction in 4 years. And the multiple on the market has gone from 12 times to 17 times earnings. And that has been a fantastic environment for anyone that owns assets. And a lot of it was driven by artificially suppressed interest rates by central banks around the world. So that's what the last 5 or 6 years look like. Today, we have a market that looks fairly valued from a multiple perspective. We're probably a slight premium to where we've traded on average historically. Interest rates are probably rising. And over the last few years, it's been extremely difficult to short stocks. Frankly, it's actually been pretty tough to be an active manager. The best performers have been just low-cost, passive, long-only ETF investing. And those, more and more money flows are into these types of ETFs, and people think that that's the way to invest going forward. Those types of investments perform well in a bull market with low downside volatility. I think that's behind us right now. I think the pendulum's going to swing toward active management. I think stocks right now, that multiples are fairly valued, are going to move based on earnings. And I think that plays into the hands of people that are doing deep dive fundamental research, projecting where earnings are going to go. And I think that there's a lot of money to be made on the short side at this point right now. And I think to preserve capital and generate returns going forward, I think shorting stocks can be a major component to be successful. So if there ever has been a time to look at a fundamental long-short approach, now's probably the time. I feel like you have a pie chart, you should always have exposure, and you shouldn't try to be tactical. But I think that it's going to be tough to generate returns long only that you've been accustomed to over the past.
So I'm not a macroeconomist, and neither are the 7 people on my team. We look at managers all day. We have 2 macroeconomists on staff, and there's probably another 5 or 6 that just focus on equity markets and on macro factors. My view on it would be, look, as Neil stated, we're in the 7th year of quite a historic bull market, and I don't think people are really thinking about it, but based on price appreciation, this is the 3rd largest bull market in history. Based on length of time, it's the 4th largest. And from my perspective, I think you throw out the bull market from 87 to 2000 because from my perspective, that is something that happened in history that it's unlikely to ever happen again in our lifetimes, which was essentially the abandonment of Marxism by both the Soviet Union and China and the other half of the world adopting capitalism and trying to move the ball forward in terms of advancing technology and capitalism and really operating in a for-profit construct as opposed to a construct of 2 superpowers trying to destroy one another. I think that is a bad one. So that makes this current bull look even larger than it otherwise would. You couple that with fixed income yields at 2% on the US Treasury, and I believe we're definitely on the tail end of what was an incredible run in bonds that began, maybe in the early 80s, but arguably for over the last 30 years. And so historically, during this period of time, anytime we've had a pullback in equities, you've had your bond positions there to bail you out. And I'm not sure that you're going to have them there, or at least not to the extent that you've had them in the past. And so having exposures to hedge funds that can have other types of risks exposed built into them is a prudent idea. I don't think it should be 100% of your portfolio. I don't think it should be 50% of your portfolio. But I think having that exposure somewhere between 20 and 30, 35% of your portfolio is very prudent, and I think it's more prudent now than it has been in the past. That's what I would say.
Okay.
One thing I would just say is, I would say that the appetite for strategies tends to be inversely correlated to that strategy's attractiveness. So I think that, as Chris said, that it's critical now to have alternatives exposure. Most people are feeling pretty good about being long-only stocks and long-only bonds and feeling pretty bad about hedge funds. And I think that sentiment is a classic contra-indicator.
Okay, excellent. Thank you. All right. Just one point to kind of add to this, and it sort of embellishes upon the argument of investing in the alternative investments area. If you look at and you understand the traditional equity analysis process and investment strategy process, what you have is you have a bias towards a methodology that brings about what I call them when I was on Bloomberg Radio a few weeks ago, transitional blindness. There are transitional blind spots that occur during periods when you might be shifting from one to the other, where you have things like hard to quantify factors, some of them have been described here, and then other ones with geopolitical risk and behavioral finance and things of that sort. And if you look at how your traditional portfolio manager does what he or she does, is that they are reliant upon a traditional process whereby the macro environment looked at by traditional economists that have long-dated cycle items that come their way to then identify where the changes might occur that would impact then the financial model, which impacts the valuation model that drives the investment decision by the traditional portfolio manager. Okay, if you look at that process, there is no basis whatsoever for anyone to speak in the manner that what you just heard. It's really very straightforward. Earnings, growth of earnings, and a discount rate. And embedded in the discount rate is what? Risk and interest rates. And if those things are favorable, then you are engaging in career suicide if you bring in things like geopolitical risk and some of the other items. this is an argument not so much against the traditional approach to analyzing companies and investment strategy, and for methodologies that incorporate things that are hard to quantify and have a more diverse area to invest in. Now, that little item there may ultimately find its way into being a book. So we'll see if we can make that all happen with a publisher in a not-too-distant future. It's an argument to be made. It's an outgrowth of my exposure to alternative investments. And it shows me, when I look at the country, I do these events all over the country, and you'll see it when we do the forecast event in January here, January 20th. That'll be more traditional straight up. And you will not hear people say, panelists say, about concerns in the manner that you've heard here. It's simply because you cannot quantify some of those elements. And if you can't quantify them, then you cannot put them into your decision-making process. And if you can't put them in your decision-making process, you cannot act. So it's like the John Maynard Keynes quote, which is, for your reputation, it is better to fail conventionally than to succeed unconventionally. And that is an indictment, frankly, of the traditional equity analysis process. That's why they get blindsided when you have changes and all of a sudden it's like, what happened? Where did that come from? 2008 being the most recent example. Okay.
Thank God Silicon Valley doesn't follow Keynesism.
Oh, okay. All right. Let's go with closing comments, if we would. Okay, this is one thought, one item, because we're running a little late in the evening, that you would like to leave with everyone. So I went from outside in, so now we're going to go inside out. So Chris, just give us a closing comment, a thought, an item, something we discussed, something that you want to share with us to leave with everybody.
Yeah, I think I sit on a lot of these panels, and generally I think there's a knucklehead or two on the panel, and that wasn't the case tonight. So I really enjoyed this immensely.
Thank God for that.
I think everyone made really intelligent and I think really honest comments. I think, you know, people talk about hedge funds and they talk about them in a very sort of oblique and mysterious way. And I think what you heard tonight is they're not oblique. It's just very, it's a simple bottoms-up analysis that's required to understand them. It's not easy, but I think not including them in an allocation is something you do at your own peril. And so I think there's a logical place for a variety of hedge fund strategies in various sizes, depending on sort of an individual risk profile, whether it's privates, whether it's long short, whether it's CTAs, whether it's credit, whether, you know, all of these strategies have a place in the portfolio, and I think you just need to understand the characteristics of each of them and what you're really trying to solve for. And when I'm building a portfolio, the way I think about it is I want exposure to not just risk, but different types of risk, right? And so the risk in what's driving a merger arb strategy is very different than the risk that's going to drive your long-only equity strategy up or down, or the risk that's going to move your CTA strategy is very different than the risk that might move your long-short equity strategy. And so I think the idea of marrying these different types of risk to create a overall statistically more robust portfolio is the right way to do it, because I think at the end of the day, what we all are trying to do for clients and ourselves is stick to this investment program. And the way to stick to this investment program is to avoid the very steep drawdowns in NAV. In other words, those peak to trough moments, because everyone has, I'll use maybe a medical term, their sort of threshold of pain, where when they breach it, they will start acting emotionally. And when they act emotionally, the decisions they make are going to be bad decisions. And so whether that's 10%, 15%, 20%, 30%, if the inclusion of hedge funds can introduce different types of risks that can truncate what would otherwise be deeper drawdowns, it avoids that emotional decision point, which always involves making a bad decision. And I think that's not just in investments, I think that's in everyday life. When we're emotional or upset about something, it can affect our ability to drive a car, it can affect our ability to have a smart conversation. So if we can avoid that threshold of pain, I think we're doing ourselves and our clients a huge service.
Thank you. Neil?
I think on the hedge fund side, they're structured as LPs, and so they're not mutual funds. And so making investments in this space requires an entirely different set of diligence than you need to conduct for other types of investments. I think investing in hedge funds, you need to take the approach of trust but verify, and you need to ask and require sufficient transparency so that you can intelligently make decisions both upfront before you make the investment and also on an ongoing basis. So it's a different skill set and it's a different requirement to invest in this space. And I think that, as I said at the beginning, there might be 10,000 funds out there, and 90% you wouldn't want to invest with. You really need to kind of go through the standard process of verifying everything they've said.
Thank you. Brodi?
Yeah, I think as you're looking at alternatives, I think there's definitely a spectrum, and I'm at one end of this spectrum that shouldn't be a large part of anyone's portfolio, and liquid hedge funds can be a bigger piece, and anything on the private equity with a lockup should probably be smaller than that, obviously. And I think really thinking about what's your goal by going into the alternatives, whether it is to diversify correlation with the public markets, or as Lawrence had talked about earlier, there's not as many growth opportunities, because if you just look at the universe of private companies and public companies and where they are you trying to achieve just outsized growth? Really trying to understand what your objective is in investing in a certain alternative strategy. For my investors, they're looking for something that's uncorrelated with the markets and something that they don't have an ability to go out and source and execute on themselves effectively. And then I think the final thing is, really goes back to alignment of interest. If you're investing in any alternative strategy across the board, I think if you're looking at those financial incentives of the manager and making sure that you're aligned, it's going to go a long way. That may not correct for market cycles and how someone performs, 1 year versus the next, but over time, a manager that is aligning their interests with you, you're going to get better returns with that manager than someone who is disaligned with you.
Thank you. Lawrence?
Thanks. I guess I'd make one comment to Chris's point on emotion. One of the nice things about the lockup structures in private equity is you can't actually act on your emotion. You see that with the recent articles on hedge funds and oil I referenced earlier, and people are out trading because they don't know what to do. If you're in a private equity structure, the nice thing about it is that the manager actually can time their exit absent that emotional move in the market. And so while everyone does worry about the illiquidity in private equity, there is a positive side to it, which it really does take out that emotional element. The other point I'd make, a lot of people have talked, Brodi just talked about alignment of interest. I think that's really, really important. The other thing that no one has talked about to date that is really, really important is culture. There are very different cultures, having looked at a lot of private equity funds and hedge funds. That organization, the importance of culture is no less significant than it is at Cisco or Google or Apple. Pick your favorite company. It's arguably more important because the number of professionals in a financial organization tend to be smaller. And these businesses, private equity businesses, hedge fund businesses, we like to think of them, they're dining room table businesses. They're a bunch of partners sitting around a table trying to figure out what to do. What should we invest in? What should we do the companies we invest in? And when should we try to monetize them for our investors? If you don't have a culture where people are in it together, where they're all working for the same aligned incentive, not just with their investors, but with each other, that's the recipe for ingredient. So when you're looking at the managers, whether they're private equity or hedge fund managers, see what you can find about the culture, about how the people interact with each other, what's the incentive system, particularly if they've got multiple funds, if they've got people in geographic offices that are spread around the globe. How do they interact? Those issues tend to be important issues over time.
Thank you. Tom?
Being in finance, we tend to look at things quantitatively, and we're no different. Being a high-yield fund, we look at interest coverage, debt levels, all of those measures. But I keep hammering on our staff to look at other things, to look at the qualitative factors, because businesses are made by people, and you have to understand the incentives, what's motivating management, what's motivating people, and why these companies are likely to perform versus not perform. And those things are critically important, much more important often than the quantitative factors, which everyone looks at. Where am I going with this? If we look at this board, you have a tremendous diversity of different strategies and skills from venture capital and private equity, short out, long short, et cetera. If you look at the high yields or the hedge fund space, one of our questions was looking for one fund. What I'd urge all of you is not to look at one strategy, to look at the diversity and to try to understand the diversity that you have in the hedge fund space, because they're all extremely different managers. Every firm, as Lawrence pointed out, has a different culture, and those things are critically important. So if you're going to invest in this space, whether it be in private equity or in venture capital or in hedge funds, do the due diligence. Go out, visit the manager, understand their culture, know exactly what they do, know their incentives, understand their fee structure. Don't be like CalPERS. Know exactly what you're buying. And know that those fee structures, that those incentives, that the desires of the manager and the team are aligned with your desires. And really do your homework and know how that investment fits in your portfolio, and understand why that manager is going to work for you.
And just one thing to add to that, make sure there are no knuckleheads. Okay, very good. All right, January 20th, forecast event coming up. Please remember that, mark it on your calendar. Should be real good. Thank you to all of you for coming here this evening. Thank you to the Society for putting on this program, 13 years running. Special thanks to Phil for making this all happen year after year after year. Great job. And please join me in thanking our panel for a really excellent discussion.